with this tax planning, something I'm a little bit concerned with, especially with the charitable giving that you were talking about, is alternative minimum taxes and where that comes into our planning and how you guys reflect that. Because if I'm going to drop, whether it's 50,000 or 250,000 into something, then all of a sudden it's not going to go the way I plan, I might kind of be shooting myself in the foot.
That's an excellent question. So as a part of the tax planning, we do definitely want to look at the alternative minimum tax. There are some portions of the strategies that we're going to use that will impact that, but it's totally okay. You can definitely bring that up with your planner, have a conversation about that as you're going through these. You can be like, hey, well, how does this one play into the minimum tax? And we'll discuss all those with you so you're prepared for that.
Maybe explain this to everybody what that even means.
The tax code's written to make sure we all pay our fair share, depending on what you think of that. The alternative minimum tax is a way to kind of capture you if what Congress has decided is too much of a deduction on your regular tax. There's an alternative minimum tax calculation that comes through and does another calculation and says, well, your fair share actually still is this, despite what your regular tax says. So you can be hit with a secondary tax bill that you weren't expecting, which is what you're asking about.
Certainly that's something we're going to look at with you, but how it's going to impact you will need to be a little bit more individual, but that's something that we're aware of, that we look at, that we take into consideration and talk through with you.